5 reasons investors are pivoting to emerging markets. Hey there, sophisticated thinkers. If you're suspicious of the continued outperformance of the Magnificent Seven and curious about where savvy investors are pivoting to next, this discussion is tailored for you. International markets have sparked fresh interest lately, and one area turning heads is emerging markets. Because who doesn't love a good comeback story? Emerging markets have underperformed relative to benchmarks like the S&P 500 for over a decade amid US tech dominance, a strong US dollar, and China's many challenges including regulatory crackdowns and property collapse. But as we look at late 2025, dynamics are evolving. The MSCI EM index is up about 27% year to date through mid-November, surpassing many developed market benchmarks. Let's examine 5 key reasons emerging markets are drawing attention now. First, consider the cyclical potential from a weakening dollar, because even the mighty greenback can't stay strong forever. Analysts cite expected Federal Reserve rate cuts in response to moderating U.S. economic growth alongside uncertainties from potential tariffs and fiscal policies, and the U.S. national debt surpassing $38 trillion and continuing to climb as key factors signaling the potential conclusion of the U.S. dollar's prolonged bull market. This shift historically aligns with stronger EM equity performance during dollar depreciations, as it can enhance local returns in US dollar terms, help EM borrowers of dollar-denominated debt, and reverse capital flow back to EM. This trend is observable now, with EM currencies showing strength, particularly in resilient markets like Brazil and emerging Europe, such as Poland and Hungary. This emerging FX momentum highlights a compelling angle for those tracking global currency shifts to assess potential boosts in EM asset performance. Second, EM is projected to show a robust growth again while the US might be catching its breath. IMF and World Bank estimates suggest EM economies could expand at more than 4% annually from 2025 to 2027, outstripping developed markets' 1.4% pace, a differential that has often corresponded with relative EM equity strength by drawing investment capital and consequently boosting earnings. This is complemented by EM central banks' easing policies, with rate reductions in 2025 and beyond, along with moderated local inflation and weakening US dollar. Such developments typically support local liquidity, profitability, and growth through reduced borrowing costs. As US growth moderates, EM is expected to rise in a multipolar global economic landscape. Third, the growth outlook in various sectors in EM is improving. First, intensifying investments in high-tech and manufacturing have aligned with the global AI trend, supply chain diversification efforts, and local net zero objectives. Countries like China, India, South Korea, and Taiwan are prominent in EVs, renewables, and semiconductors for communications, AI, and electrification, areas where entry barriers may sustain growth. Second, a softer US dollar could also elevate commodity prices, aiding exporters in Latin America and Southeast Asia, especially as supply chains adapt to geopolitical factors. The changing landscape in global trade is providing ample opportunities in various pockets of the export-driven emerging markets universe. These developments have been attracting many smart global investors, tracking megatrends, offering compelling opportunities in these underrepresented high-growth areas that can outweigh broader slowdowns. Fourth, EM's quality improvements are enhancing its profile. Many EM countries have invested in transforming their economies over the previous decades, dramatically enhanced corporate governance practices, and improved fiscal measures stabilizing debt. Credit upgrades prevailing in recent years are a testament to the reduced risk premiums, as many EM countries have reduced susceptibility to events like the 2013 taper tantrum. The MSCI EM index reflects this trend with weights in sectors like IT, communications services, consumer discretionary, consumer staples, and healthcare totaling roughly 57%, up from 45% 10 years ago in 2015 and 33% in 2005. This approaches the developed markets at 62%, although a bit behind the S&P 500 at 70%. EM's progress in this area is very notable. Finally, valuations after EM's lost decade of low single digit returns are at historic lows. EM's PE ratios are now at 30 to 40% below developed markets and US levels. This setup may suggest mean reversion potential, particularly with 2025's 28% year to date gain indicating early momentum. It's interesting to note that Goldman Sachs recently released their forecast of 12.8% annualized EM returns over the next decade, compared to the US's 6.5%. Additionally, EM offers diversification value as the least correlated equity class globally, with a 10-year correlation to the S&P 500 at around 0.72, lower than all other major regions. This can potentially help in volatility management during downturns amid US tech concentration. These are 5 reasons emerging markets are drawing attention in 2025 and beyond. If this piqued your interest, like and subscribe for more explorations to come soon, and drop your thoughts in the comments. Thanks for watching and keep questioning and learning.